think where inflation is going.
Yeah.
We're not, when you look at the, and I think one of the points he made about traditional economics, you look at the growth we're running and think about in the second quarter, you're getting over 4% real GDP. And you're not going to create, and when people look at these traditional metrics of what creates inflation, we're just not going to create that much inflation. Core PCE, the Fed's favorite metric, still under 2. You know, I was thinking about the other day, when you think about what you guys talk about, and whether it's the Amazons or the Apples or the Teslas, et cetera, and you think about the way the real economy is today, or take the market cap of the S&P, you have incredibly different consumption today. You think about all these companies, how they're driving down inflation, and they're creating dynamics that are more efficiencies. But I just always blown away by people say, well, if you hit this level of GDP, you've got to hit this level of accelerating inflation. I actually don't buy it.
Here's what I don't understand, though. We are hearing from employers constantly that they are having to pay more for labor. That rate is rising. You're not seeing it in average hourly earnings yet, but it's hard to think that doesn't start to really pop up at some point.
So you think a couple of things are happening. So first of all, I think average hourly earnings were running about 2.8, 2.9. So it's not bad, but I think your point is right. You are getting wage acceleration, but the question is, does that have to translate into price increases? No. And can companies actually get pricing power? If you look at some of the home data recently, you know, you're starting to see some back off in terms of some of those levels. I think the consumer is very different today. You get these wage increases, more and more is getting into savings. Yeah. People are thinking about retirement. They're thinking about, what is my consumption basket here today? By the way, I can do most things on my phone today. I don't actually need the traditional. I don't need a TV. I don't need a radio. I mean, so many things. I think the consumption basket has changed. And I think the dynamic around, can companies get through in a world of Amazon, in a world of companies that are pressing down? I think the whole gig today, when you think about where CapEx is going, is to make your company more efficient. You have to be the cheapest manufacturer, producer, marketer in the world. And it just, I'm not saying you don't create some inflation. We're going to run 2.5 core CPI. But there's just not that accelerating pressure.
Do you understand how the yield curve and recessions are related? Can you explain that to us? Here's what I got. Here's what I got from him. Here's what I got from him. Don't mess with the yield curve if it's telling you something. Don't invert it. Don't actually take steps to invert it, because that can cause a recession. For some reason, that seems like that's putting the cart before the horse. I thought that the yield curve inverts after the conditions in the economy indicate that we're in a slowdown. Can you actually engender a recession purely from high? Huh?
No.
Well, then what's he saying?
So I'd say there are a couple of things. First of all, if you take historically, what's the best indicator of an impending recession? It was the shape of the yield curve. However, there's a couple of things happening today that are really significant. One, the pension fund demand for long-end interest rate products is extraordinary. That's pressing down the long end of the interest rate curve. 1 point, meaning you're flatter than you should be, given that dynamic. The second is, you think about what's propelled this economy higher. You've got incredible stimulus, and the view is, which I don't disagree with, you're going to accelerate fast, and then the economy is going to start to moderate from here. So you don't need to go much beyond 2.5, 2 3/4 in terms of interest rate moves. And then the third point is, long-end interest rates would be much higher if we thought inflation was going to accelerate, and the world, myself included, doesn't think that's going to happen.
You didn't even mention the German bunds. I guess that ties into the pension demand. Like, if you have all of these people in funds who have to buy
100%.
bonds, and the only place they're going to get anything, relatively speaking, is in the United States.
So I mean, it's a bit more complex because you have the cross-currency basis, because you've got to manage where your hedges are. But the last time actually I was on this show, we were talking about, I still think rates can move moderately higher. I think the 10-year is going to go into the 3s again, but low 3s. But the point we were making is, when you think about what Draghi said, he's not moving interest rates till at least the summer of 19. It's pretty hard for our interest rates to move dramatically higher anytime soon. So I think rates can move a little bit higher, but they're pretty darn capped.
Why is the Bund so low, though? Is it simply the European Central Bank there, or is it the same issue that there are pension funds there and insurance companies there that have to be purchasing those?
So there's a bit of complexity around people, the buyers, and swapping back to dollars, and it actually is attractive for places like Japan to buy things like bunds or French oats, et cetera. That being said, you also have a central bank that's keeping rates extraordinarily low and owns the bunds. I mean, the net supply. Every time you short it, we like to short bunds when they get down to 28 or 29 basis points in the 10-year. But every time you do it, you're fighting against a supply-demand dynamic, because Mr. Draghi owns virtually all of them.
I'm told that Justin Bieber and some of the Real Housewives are on one of the other morning shows, but everybody's switched migrating, because they heard we were talking about the yield curve over here. So like en masse, everybody in the country, honey, quick, change that. They're talking about the yield curve.
Yeah, for smart people, it is what they're watching.
Nothing more exciting.
It is.
Nothing more exciting than the yield curve.
No, I brought it up. Okay. So what I kept saying I was worried about was, so we're tethered to these low rates because the rest of the world is still easing because they have no inflation. How do we know that we're not responding to economic conditions that aren't even here? And our whole interest rate structure, our yield curve is based on conditions that aren't here, and we may be missing the conditions that are here that warrant higher rates. And we're inflating assets and not unwinding the balance sheet, and we're stuck where we were 5 years ago. How do we know that that's not happening?
So that's an hour-long question.
Is it really?
You're going to ask me about Justin Bieber.
Well, now that we've got 100% viewership, we can.
Yeah, but I think you're talking about something that's really, really important. The global, and it'll be interesting to see what Powell says today about the global economy, because the global economy, China, Europe, emerging markets, is actually moderating today. Our economy is going to do extremely well. The data you're going to see over the next couple of quarters. But part of why the Fed has to move, and part of why I don't agree we should stop now in raising rates.
You don't?
No, I think but when you get to what the neutral rate is, let's say that is arguably 2.5, 2 3/4. There's no reason to go any further. You're not going to have inflation frightening you into moving further. You don't want to drive the dollar up. The biggest risk to the economic system today is the dollar appreciating significantly. If the Fed were to keep moving to get to restrictive policy, you force the dollar higher, you create a real dynamic around foreign exchange reserves. Part of why you're seeing crises in places like Turkey, Argentina, Italy, Brazil, is there is a lack of dollars in the world, and you create this, you force the dollar higher. It's a tricky thing when Treasury has to issue tremendous amounts of debt.